In this video, we'll talk about the introduction to international tax with respect to U.S. income tax. Now, this is a topic that could have many courses, not just one course, but many courses. And we're going to talk about first the distinction between U.S. outbound international tax issues and U.S. inbound international tax issues. So it's first important to understand the distinction. We're looking with respect to the U.S. So whenever you hear the phrase outbound international tax issues, or outbound international tax, what we're talking about is a company or an individual that is a U.S. resident or citizen or principal in the United States that's doing an activity or business abroad outside the U.S. That's outbound because the activity is going outside the U.S. even though they have a connection in the U.S. Inbound U.S. international tax is when a foreign corporation or foreign business or foreign individual has an activity or property or something in the United States going in. So again, when you're looking at the direction, you're looking at the perspective of the United States. Where is the activity going? If it's going out of the U.S. to a foreign entity, it's outbound. If it's coming from the foreign source and going into the U.S., it's considered inbound. All right, got it? Okay, so let's first talk about outbound taxation because that's really going to solidify the concepts for international tax, the basic ones. So currently, the U.S. taxes its citizens, residents, and corporations on their worldwide income. The U.S. is one of the only countries in the world that has a worldwide system in the sense that, again, its citizens, residents, and corporations are taxable on worldwide income. So if you recall, when you first learned about gross income, and you learn about Code Section 61 that defines gross income, it says gross income is income from all sources derived. Nowhere does it say domestic versus not domestic. Okay? It doesn't make that distinction. So that's very important to understand. Now, contrast this with most countries have a territorial international tax system or a territorial system where they only focus on the income that is related to that respective country, generated in that country. A nexus, a connection to that country. So in a worldwide system, we calculate tax on a worldwide level, even though you're looking at a respective country. Now we'll talk about the foreign tax credit and how that potentially can create a way that alleviates that issue. U.S. taxpayers may therefore pay income tax to foreign countries as well as the U.S. on the same foreign source. And the reason for that is if let's say that you do business in England, but you're a U.S. resident, or you're a U.S. business, your headquarters are in the U.S. Okay? Well, when you're looking at the U.S. tax, because it's a U.S. resident or a U.S. business, you have to calculate the worldwide income. And that includes the England income as well as the U.S. income. When you go over to England and you calculate the tax, they have a territorial system, and they're only looking at the tax with respect to the income in England. So what happens is there's double tax paid on the England income at the U.S. level and at the England level. So see how that works? So to alleviate this double taxation, the U.S. allows a foreign tax credit against U.S. income tax for foreign taxes paid. So in that example, if the taxpayer pays foreign tax at the England level on the England income, it can be used to offset the tax that's required to be paid in the U.S. Now, I want to specify, again, this applies to citizens, residents, and corporations in the U.S. For corporations, we're talking about corporations that are headquartered or principal place of business. Now, it's really important to understand treaties. Treaties affect various things. And again, this is meant to be just a basic discussion of some general international tax issues just to get your feet wet, just to get you understanding about some very, 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 very basic issues. These are very basic. Again, this is not meant to be an advanced topic at all. All right, just so you know. Different countries have different treaties between one another. You have to understand those treaties because those treaties can affect all different things. Tax rates, whether a respective country can have a permanent establishment in a foreign country with respect to an activity. So if you look between, say, for example, U.S. and Mexico, because of NAFTA and because of the proximity so close, there's going to be very favorable treatment versus the U.S. and, let's say, Brazil. There's going to be a lot more benefits that that U.S. residents get with Mexico and vice versa, Mexico to the U.S., because it's so close. Versus when you start getting farther away, well, it's not across the border, and it's not as much trade as we have with Mexico, both in and outbound. So it's important to understand that definition of permanent establishment can be defined in the treaty itself. What is permanent establishment? If you recall from the state and local tax discussion, permanent establishment is very much like nexus. It's what creates the taxability or the ability for a country to levy tax on a person. Now in the U.S., there are special rules with respect to residents, citizens, and corporations. And what a resident is defined under a mechanical test, which I'm not going to go into, but you need to look at that specifically. Again, corporations as well as headquarters and principal place of business, again, there's special things to look at there, but it's important to understand. But if you're trying to determine what countries you have to pay tax in, you have to look at permanent establishment. If you are a U.S.-based company, if you do business all over the world, some countries you might not have permanent establishment. You might not have to file. Other countries, you will. It's based on, again, the definition of permanent establishment, and the treaties, if you're a U.S. company, can be affected by can affect that definition. So I mentioned the foreign tax credit, which is a huge element of our international tax system. Now it's important to understand that this is a way that we can alleviate the burden of double taxation. The idea here is, if you think about the policy perspectives, right? When we look at tax policy, we have equity, which is fairness, simplicity, and efficiency. Efficiency is based on economics. If there is a transaction that, because of the tax law, would have a negative or an adverse effect to a taxpayer, and they're not going to do the transaction because they don't want to have to deal with the tax issues, being double taxed, then they might not do the transaction. That's not good for the economy. We don't want to create an incentive or de-incentive, I should say, to do a transaction just because of the tax system. So efficiency deals with economics, and that's what the foreign tax credit is all about. Obviously, it's a fairness element because it wouldn't be fair, right? If someone's doing business in the U.S. versus doing business abroad, maybe you want to encourage business in the U.S., but still you're doing business around the world and you should be paying more in tax. Well, you might want to make an argument, okay, well, yeah, we want to encourage business in the U.S., but don't we want to have the same system? Maybe you give some type of tax break by doing domestic activities. For example, we have the Section 199 domestic production activities deduction, DPAD, and that's something that over the years has been repealed and come back, so you need to check whether that's been repealed or not when you're watching this. But that's for domestic activities, okay? Qualified dividends is another example where you get special rates. That's something that's been back and forth. Again, check that. But should we have the same system or a different system where people get double taxed just by doing business abroad? And again, this is an economic item, having the foreign tax credit. It's based mostly on economics. There is a fairness element, but it's almost all driven by the efficiency argument, which is economics, that, okay, this makes no sense. And you're going to see that even more when you look at the limitation. Now, it's important to understand that only foreign income taxes are eligible. All other foreign taxes, property taxes, employment, excise, tariffs are not part of that. It has to be income-based taxes, international, the foreign income tax. And it's going to be the amount paid. Just like when we talk about state and local, you can deduct the amount paid. Very similar, it's the amount paid, not the amount accrued. Now, if you're a partnership or S corporation and not a corporation that gets the benefit, this foreign tax credit can flow through to the partners and shareholders through their K-1s. This is a separately stated item, and because it's a separately stated item, it will be computed on each taxpayer's own return, based on various limitations respective to that taxpayer. The reason for this is you're going to see the limitation in a moment. Again, we look at the amount paid, the amount actually paid, and there's going to be a limitation on that. Whatever is lesser is what we're going to take. Similar analysis for C corporations in the following slide showing the limitation. So again, when you're looking at the amount of the credit that can be taken in a respective year, you do this based on the foreign tax paid in that country. So a lot of times companies will break it up by countries. So it's either the lesser of the amount of tax paid with respect to that activity in that country, or the U.S. tax before the foreign tax credit times the ratio of foreign source taxable income over worldwide taxable income. You might be thinking, why do we have this limit? Well, the reason is because in many other countries, especially if you're looking at personal taxes in a lot of other countries around the world are a lot higher, especially over in Europe. You can have tax rates over 40% on some income for individuals, okay? For some individuals. And the issue becomes, you can have this system where you get the benefit of that tax at the 40% rate in another country, but then you come over here to the U.S. and you get to bring that 45% rate, and that brings an abuse issue. So the limitation creates a lower rule. It really stops it where in the foreign countries, the rate's higher. Because the idea is that we need to keep it limited to the U.S. tax. Now, obviously, when you look at this formula, it doesn't always equal out to that. There could be some other elements, but that's really what it was meant to do. And again, that's what the efficiency, the economics is all about. It's trying to keep the limit to the U.S. actual tax rate. So there's a 35% U.S. tax rate on individual income, and that's what they're subject to, the individual is. You can't get 45% because that's what it is in England, and that's what they pay tax on. That would create abuse issues. Now, any unused credits are subject to a 1-year carryback and 10-year carry forward. After the 10 years, they're going to expire. They're going to just disappear. In each carryback or carry forward year, the amount carried to that year plus the actual foreign income taxes incurred for that year are in total subject to those annual limitations. The limitations we just mentioned. You have to calculate this limit every year. U.S. tax before foreign tax credit times the ratio again of foreign source taxable income over worldwide taxable income. So again, we're still dealing with outbound. U.S. residents, U.S. citizens, U.S. corporations that are doing business abroad. We're trying to look at their tax in the U.S., and when you have to pay tax outside the U.S. on those activities, but you're calculating the worldwide effect in the U.S., you get this benefit, but it's limited. Now, the credits are used up on a FIFO basis. The earliest credits are applied to the annual ceiling limit before later credits. So if you're not familiar with what FIFO is, first in, first out. The first credits are the first ones used. This means that carry forwards, for example, must be used first in meeting the annual limit in the carry forward year before using actual credits earned in that carry forward year. So that's basically a rule that an anti-abuse rule that the IRS saw was happening, and this is not something that's good for the taxpayer. This is something good for the government. Now, it's important that you go through some examples with the foreign tax credit numbers. If you're taking a course, maybe you have a textbook. If not, go online. There's plenty of ways to find this. Find an international tax supplement. That will help you because when you're doing the foreign tax credit limitations, the lesser of rule and all that, going through different examples really helps. Okay, it really does help. So when you're looking at the foreign tax credit calculation, you really do have to break it into baskets. So if you remember in previous discussions, we talked about passive activity rules for various entities. If you have different baskets, portfolio, active, investment income, right? Portfolio is the investment, active income is what you manage, and then passive, right? You have to break that up also with respect to these items. So it's a similar type of analysis. So if the foreign income is earned in separate baskets, examples business income, which is going to be active, versus investment income, which is passive, the annual limitation must be computed separately for each basket. So you have to do the annual limit for each basket separately. And the ratio or formula is going to be the U.S. tax before the foreign tax credit again times the foreign taxable income in that respective basket, right? So it'll be portfolio, active or passive, over the total worldwide taxable income. And that will create the, again, the limit on that item. Okay, so now let's talk about inbound taxation. And we're going to focus on businesses because this is where you mostly see this. It's possible to have an individual outside the U.S. with inbound issues, activities going on in the U.S., but it's usually when you have foreign companies that do business in the U.S. So I just want to give you some examples, right? If you have a U.S. company, U.S.-based company, headquarters, principal place of business in the U.S., like Walmart, okay? And they are doing business abroad, that's an example of outbound. Because, yeah, of course we have lots of activities in the U.S. that Walmart does, Walmart Corporation. But they also have activities outside the U.S. They have a lot of stuff going on in Mexico. And we have to, again, calculate on the worldwide system. An example of a foreign corporation is a corporation that a lot of automotive companies, for example, are foreign corporations that they have most of their business outside the U.S. They have their headquarters outside the U.S. and their principal place of business outside the U.S., but then they do have business in the U.S. That's inbound. So let's first talk about corporations. So the U.S. taxes foreign corporations and any other foreign business entity on their U.S. source income only. So if you're not a U.S. citizen, a U.S. resident, or a U.S. corporation, which again, that's defined, all those are defined definitions, then you do not have a worldwide system of income. It's simply, you're just going to be taxable on the portion of income with respect to the U.S. only, not all the worldwide. Very important distinction. And for that reason, if you have an inbound issue, you're not going to get foreign tax credits. So there's only foreign tax credits for outbound issues. Outbound taxation is where you talk about the foreign tax credit. So now we're just dealing with inbound, so no more foreign tax credit, but we got to talk about respective, some basic issues. A foreign corporation may, however, operate in the U.S. through a U.S. subsidiary corporation. The U.S. subsidiary must be a C corporation, can't be an S corporation because the foreign taxpayers are not allowed to own stock in an S corporation. So we're talking about corporate issues right now. We'll talk about non-corporate in a moment. The U.S. subsidiary cannot file a consolidated tax return with a foreign parent. That's just a special rule with respect to consolidated entities. It can't happen. It must file its own separate Form 1120 for the corporation, for that C corporation. Any dividends paid to foreign parents are subject to a dividend tax by the U.S. and is assessed on the foreign parent. So there's all sorts of sourcing rules and whatnot for outbound and inbound transactions. I'm not going to get into those, but that plays a big part, okay, of what exactly is considered the U.S. source income, the sourcing rules. The tax rate is provided in the income tax treaty the U.S. has with that country. So we just don't simply apply our normal ordinary rates or capital gains rates. We apply the rates based on the treaties. If there's no treaty, then you're going to have to look at the respective item. Now, foreign corporations may do business in the U.S. by forming a U.S. partnership with a U.S. company. This is common. The partnership is going to report U.S. earnings to the foreign corporation in the K-1. The foreign corporation is then subject to U.S. income tax on the earnings. And foreign corporations pay income tax on the business income using the same tax rate schedule that the U.S. corporations use. Now, it's important to understand that in previous videos where I talk about business entity planning, one of the big reasons why you would ever pick a C corporation over an S corporation or LLC is venture capital funding. If you ever have venture capitals that are a major amount of the venture capital is funded by foreign investors, you always see a preference for C corporations for two reasons. Because they want preferred stock usually, so they have their preference on liquidation. And the other is because they don't want to have effectively connected income, which triggers basically a more taxation than they need. So they do it through a corporation. Because if they do it through a partnership, a pass-through, or an S corporation, another pass-through, guess what? Those owners that are foreign investors, they potentially could be subject to tax at their personal level on various things. So doing it through a corporation can be done. And that's exactly what you see here. Corporation forms a partnership with a U.S. company. The corporation is a foreign corporation. U.S. corporation is a U.S.-based company. And yeah, there is going to be some earnings that are subject to U.S. taxation, and that's what flows through the K-1, but it doesn't create this effectively connected income to all the individual owners, just the entity. So that's very important. That's something we talked about with the business entity planning. If you're watching this, I highly recommend watching that business entity planning video. It goes through all the different distinctions, and early on I talk about why you might want to be a C corporation. That's the first question. And again, I mentioned that it's important because it creates an issue where effectively connected income for the owners if you're not a C corporation, if you're doing, if you have lots of international owners. Now, foreign corporations can also conduct business in the U.S. by means of an unincorporated branch, usually through a single-member LLC. So what happens is the corporation as a member owns this LLC, and it does it through an unincorporated way. And what they're trying to do is they're trying to avoid some level of tax. So if they have permanent establishment in the U.S., they're subject to the U.S. tax on their U.S. earnings from this branch. We call this the branch level tax or branch tax. The tax rate schedule is the same facing U.S. corporations. So we apply the normal corporate rate, even though it's an unincorporated organization. Very interesting. Now, in addition, the foreign corporation operating in the U.S. through a branch office, a single-member LLC, that's usually an example, is subject to the branch profits tax. So that's in addition to that, what we call the branch tax, which is basically creates those rates with a branch profits tax. The branch profits tax is assessed on the after-tax profits that are repatriated back to the home office in that foreign country. So even though the business is going on in the U.S., the earnings flow back to the home branch or the home office, which is in the foreign country. The tax rate is the same that's assessed on dividends paid by U.S. subsidiaries of foreign parents. Now, treaties have different rates, and I'll just give you an example. In Canada, because Canada and Mexico have very favorable rules with respect to the U.S., Canada has a 5% dividend rate, which is a lot less than the normal rates, and then Mexico has 0. So that's very interesting. So if a Mexican corporation is doing business in the U.S. and the profits flow back to the U.S., and this is through a branch in the U.S., not an actual entity, not a corporation or a partnership, but a branch in the U.S., an unincorporated branch, single-member LLC, then Mexico is not subject to that tax in the U.S., so a very favorable rule for Mexico. So that's really all I want to talk about. I just want to talk about some basic level items, inbound, outbound. There is a lot more. Please, 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 don't think that this video covers all the basics. This is just a few basics. I could go on for hours talking about just basic level international tax issues. We could talk about what do you need to establish residency? What is a U.S. corporation? What are the different areas when it comes to permanent establishment? These are all big, huge things in international tax. And there's plenty of other things. More issues with foreign tax credit. So please, I recommend just using this as a way to springboard. And there's a lot of interesting stuff in international tax. I hope I'm showing you just a very, very, very a small drop in the bucket of issues. But hopefully it's something that gets your mind understanding what international tax is about to help you think about the big picture.